The Federal Reserve has begun its controversial bond buying program known as QE2. My colleague, Louisa Boyson, spoke to Dr. Doom, Nouriel Roubini, and asked him what happens next now that this program is underway.
The real economic impact is going to be relatively small. So even if we're doing $1 trillion of additional QE, and what the Fed has announced is only 600, economic activity next year in the U.S. is going to be maybe 0.3% above what will be otherwise. So if growth without QE2 was, say, 2%, with QE2 of $1 trillion will be only 2.3%, still below a potential growth of 3%. So the real transmission is limited for a number of reasons. One is that banks are not going to lend most of this money. They're already sitting on $1 trillion of excess reserves after QE1. And why would they lend the second $1 trillion of excess reserves if they're not lending the first one? There are problems of credit and solvency, it's not of liquidity. Secondly, one of the transmission effects of QE2 could be to a weakening of the value of the dollar, but that weakening of the dollar is increasingly being resisted by the fact that everybody else in the rest of the world doesn't want their currency to appreciate too much. So even that transmission to real economic growth is going to be more modest.
But can you have solid monetary policy without following up and having fiscal policy at the same time? I mean, isn't that where the disconnect is, that we kind of need both? And you talk about inflation. I mean, if the Fed is stepping in and buying additional 7- and 10-year bonds primarily, shouldn't it also have included buying a lot bigger portion of the 30-year bonds, despite the fact that you might not want to hold it in the short term if indeed you do start to see inflation and a continuing weaker dollar?
There's an important relation between monetary and fiscal policy. Certainly QE2 implicitly is some monetization of fiscal deficit, even if, of course, the Fed and the U.S. Treasury would not admit to do so. But the relation between the two is tricky because on one side you could argue that countries like the UK or even the Eurozone, where there is more aggressive front-loaded fiscal consolidation, that we know it's deflationary and recessionary, recent stat by IMF suggests that raising tax and cutting spending reduces output. So the way to compensate for that would be to have easier monetary policy. Now that's in some sense the implicit agreement between Cameron and Mervyn King in the UK, where effectively if fiscal consolidation is going to occur, it's going to slow down growth, the BOE is likely to do another round of QE. They have not yet announced it, but I think once the pain of the austerity is going to come, and you already see people in the streets throwing rocks against that austerity, and the real pain has not yet come.
Well, we saw the inflation report yesterday. I mean, they're indicating that it's not quite there yet, but they're not either closing the possibility completely. Yeah,
inflation is a bit higher than expected. Some of it, I think, is level effects, and that's a constraint. But I think that once the austerity on the fiscal side occurs and growth is going to slow down as it will, then the BOE is going to react by doing more monetary easing. In the case of the Eurozone, however, you have a problem because the periphery is still contracting. Output is still falling in Greece, in Spain, in Ireland, and it's barely growing in Italy and Portugal. The sovereign spreads are going through the roof. That fiscal austerity is recession, deflationary. You will need easier monetary policy to stimulate growth, and easier monetary policy by ECB also to weaken the euro. Instead, among the major advanced economies, the ECB is the only one who's signaling no QE2. And there is also fiscal consolidation in Germany that reduces further economic activity. So the right mix will be that if you decide politically, because the market wants you to do early fiscal consolidation, monetary policy should be easier and your currency should be weakening. That's what's not happening.
Everybody's still scratching their heads trying to figure out what on earth is going on with Europe. We've had QE2 out of the way. We've had the jobless numbers out of the way in the U.S. We had the midterm elections out of the way as well. And now it seems the focus is once again back on these periphery economies that you mentioned in Europe. But nobody can quite seem to figure out what it is that's driving the spreads wider all of a sudden on a day-by-day basis, because the story kind of hasn't changed over the past couple of weeks. It's kind of the same story that's taking place in Europe. At what point should the ECB step in and say, we're going to buy a whole lot of more bonds than what we already are buying?
The position of the ECB, in my view, is not very, productive, because it exacerbates this problem. In a situation in which there is massive fiscal consolidation, it's recessionary, and there are these banking risks, the ECB should be, one, providing more liquidity to the financial system, two, do more extensive amount of QE2 and purchasing the bonded debt of many of the sovereigns, and there is a huge amount of resistance to do so. The first round of doing it was very small compared to what the US did. They haven't bought many of them. When there is pressure, they buy $1 billion here and there. but it's not significant to dampen those widening of spreads. So the overall thing is happening right now is that monetary policy, in my view, in the Eurozone is too tight, and the strengthening of the euro now back from 120 to 140 means that while Germany can live with a euro at 140, even 150, because it's uber competitive, the periphery of the Eurozone needs actually a euro closer to parity, not certainly at 140, soon enough maybe closer to 150. And that's damaging any chance of a recovery of growth in the periphery of the Eurozone. If there is no growth, eventually the sovereign problems and the banking problems are going to become worse.
So, if I read between the lines, what's going to happen then is that Germany is going to get pulled down. There's no way that Germany can pull the rest of Europe out of where it is now, despite the fact that we have seen an awesome recovery in Germany compared to its counterparts.
You're right. Eventually even Germany is going to be hurt. So far Germany is doing well because of their own competitiveness, because of the fact that China and emerging markets are still growing. But, 2/3 of German exports go to the periphery of the Eurozone. And if the periphery is sinking, eventually Germany is going to be hurt.
Let's come back to Ireland for a moment.
Yeah.
Do you think that Ireland will be able to fund itself internationally? I mean, it seems that if the Prime Minister Cohen, if he's not able to push through a budget come December, that they might have to go to the bond markets again in January, and that could prove very difficult.
I think that the trouble of Ireland is that it looks like on the same path as Greece. Now, their funding needs are only significant starting with June of next year. There is some before, but most of the bulk of it is going to be June. So they can sort of fudge it and wait about an IMF program or going to the European Stabilization Fund for another 6-7 months, but eventually going to get there. And market dynamic might force them actually with this now spread widening to do it earlier than otherwise. This issue of kicking the can down the road creates a bigger problem down the line. We start with private debts. We decided to socialize them in Ireland, in Spain, in other countries by putting them on the balance sheets of the government. Now, some of these governments like Greece are effectively bankrupt. They've lost market access.
Yeah.
Now we have super sovereigns that are bailing out the sovereigns, like the IMF, the European Stabilization Fund, the Eurozone. But there is this much can kick the can down the road because nobody's going to come from the moon or Mars to bail out the IMF or the European Stabilization Fund. So this transfer of losses from private to public to supranational eventually is going to run its course.
Are we going to see further sovereign defaults?
I would say yes in the following sense. Rather than formal defaults, like in the case of Greece, what I think are going to see orderly but coercive restructuring of the public debt. Those orderly debt restructuring have occurred in the past for sovereigns in Pakistan, in Ukraine, in Uruguay, in the Dominican Republic. They will occur in a case like Greece, and they will occur eventually for a country like Portugal and Ireland, if it's likely they're going to end up in trouble.
Spain?
The size of Spain in terms of its GDP and its debt, private and public, is so large that the amount of envelope of official resources, IMF and European, may not be sufficient if they lose market access to roll over their debt and finance their current fiscal deficits. If they lose market access, they're not yet there. And then it's also is systemically so much more important.
Yeah.
And even a small Greece had contagious effects, let alone if it's Spain.
Yeah.
The current EU strategy is, we kick the can down the road with Greece by bailing them out and then doing restructuring. If Portugal and Ireland also get in trouble, going to do another Greek kind of solution, an orderly restructure down the line, and that's feasible if then 2-3 years down the line Spain is okay and the Eurozone has recovered and the risk of contagion has been limited. But if instead Spain were to fall off the cliff in the next 12 months, then that's a problem that cannot be as easily managed. And you can tell arguments why things in Spain are better in some dimension than Greece. The dimension which is better is one, lower budget deficit as a share of GDP, lower stock of public debt, and higher savings. But there are many dimensions in which Spain is actually worse than Greece.
You mentioned that inflation growth is low to non-existent in some areas. Again, in the inflation report that we had just here recently in the UK, they're talking about inflation heading higher in the near term over the next 18 months, and then it'll go lower again. If that's kind of the picture that we're anticipating to see, according to you, at least in the Eurozone as well as in the US, how do we prevent deflation? How do we prevent getting into that cycle where it's very, very hard to get out of this type of scenario?
First of all, in the UK, inflation is going to rise, but it's going to then fall. In the case of the Eurozone or Japan or United States, actually inflation, both core and headline, is already low and further falling because of the slack in goods and labor market. In UK, there's more of a transmission because of the fall of the value of the pound, and being a small open economy, the effects on input price and inflation is larger than the case of, for example, of the United States or Japan. I think that the only way to think about avoiding significant deflation risk is doing more aggressive quantitative easing. That's the lesson of Japan. They did not do quantitative easing aggressively enough. Once expectation of deflation became entrenched, then you end up in a liquidity trap where people are not spending because they believe prices are going to fall. If they don't spend, prices fall even further.
But isn't that going to keep the bubble growing? Isn't that going to keep asset bubbles continuing? Isn't that just going to simply make the fire worse in the longer term?
You have to consider the short term from the longer term. In the short term, there's no alternative to avoiding a double dip and deflation than doing more quantitative easing. Of course, you have to do other policies as well, but you need to do it. Then this wall of liquidity is chasing assets. Some of those assets are assets in advanced economies like their equities. Some of them are commodity, oil, energy, food, gold. Some of this money is going to emerging markets. And certainly there is a risk that QE2, and in my view, there's not going to be just QE2. The Fed eventually is going to do QE3, QE4, even QE5, because growth is going to fundamentally stay below trend and inflation low because of this painful public and private sector deleveraging. Then this wall of liquidity, or the tsunami of liquidity, is chasing assets, and a lot of these assets are going to be actually not just in advanced economies, but more in emerging markets, where there is already overheating of the economy, and the attempt to prevent currency from appreciating means that they're importing U.S. monetary policy. So stock markets, bond markets, currencies throughout EM are strengthening, commodities are rising, and that's a risk that you're going to create bubbles somewhere else in the rest of the world.
Do you think China is looking at an asset bubble now? I mean, it seems fair to say that China's kind of gone from being very focused on domestic growth, on external demand as well, and now they're refocusing on inflation risks. They're refocusing on kind of managing liquidity from within their own borders, and we saw the reserve requirements also just being raised for a number of the financial institutions just recently too.
China is growing too fast right now. There's already bubbles in commercial, residential, real estate, maybe even in the equity markets. Growth is high and too much. Inflation is rising. The only right way in which China could regain monetary control will be to allow its currency to appreciate faster so that they can have a faster rate of tightening of interest rates without engineering further capital inflows. But for a number of reasons, China is unwilling to let the currency appreciate at a faster rate, and the result of it might be that in spite of the credit and monetary tightening, you're going to get overheating and inflation rising and asset and credit bubbles. That's one of the risks that China is facing.